Have you ever just stared at your trading account and thought, man, there has to be a better way to do this? A more systematic approach to generating some real income that goes beyond just guessing if a stock is going to go up or down. Well, today we are diving deep into a strategy that's built to do exactly that. It's called the wheel strategy. I want to start with just one number, 90%. Just let that number hang in the air for a second. In the world of options trading, what do you think that number represents? Well, it's the percentage of retail options traders who lose money. Yeah. According to the Journal of Finance, a staggering 9 out of every 10 individual traders are in the red, with the average account losing about 36% a year. It's a brutal reality, and it's because most people are playing a game where the odds are just fundamentally stacked against them. So how do we fix that? How do we flip the script? Well, the answer is pretty simple, actually. We have to completely change our mindset. We have to stop thinking like speculators and start acting like the professionals who pull consistent profits out of these markets. And this right here really shows the two different worlds. On one side, you have the typical retail trader. They buy options. They're basically buying lottery tickets, hoping for some huge explosive move in the stock. The problem is, they are literally fighting against time itself. Every single day that goes by, their option loses value. It's called time decay. But the wheel operator? They do the exact opposite. They sell those options. They actually make money when the stock does nothing at all. And that time decay, it's not their enemy anymore. It becomes their single greatest ally. So here's the bottom line. If you want to change your results, you have to change your role in the game. It's that simple. You have to stop being the gambler buying the lottery tickets and start being the casino that sells them. The wheel strategy is how an everyday person can do exactly that. Okay, so let's break down how this actually works. They call it the wheel for a reason. It's a predictable, repeatable cycle that just keeps on turning. You can really think of it as a little cash flow engine you're building for your portfolio. And it all starts right here with something called a cash-secured put. No, don't let the name scare you. It's a simple idea. You're basically raising your hand and telling the market, hey, I'm willing to buy 100 shares of this company I like, but only if it drops to this lower price. And look, I've got the cash set aside right here to prove it. And just for making that promise, for taking on that obligation, the market pays you cash up front. We call that the premium. And this right here, this is the whole cycle in a nutshell. You kick things off in phase 1, sell that put, collect that instant income. Now, if the stock price drops below your target price, you just move right into phase 2. You get assigned the shares, which, by the way, was part of the plan all along. And from there, you roll right into phase 3. You start selling what are called covered calls on the stock you now own, which lets you collect even more income. So let's zoom in on that first phase. When you sell your cash-secured put, if the stock price just stays above the price you chose, the option you sold just expires. It becomes worthless. You keep 100% of the cash you were paid, and you're free to do the whole thing over again. You literally get paid for your patience. Okay, but what if the stock does drop and you get assigned the shares? This is the part that so many people misunderstand. This is not a failure. It's not a loss. It's a planned transaction. You just bought 100 shares of a fantastic company at the exact discounted price you wanted. The best way to think about it is that you just acquired inventory for your business. And that brings us to the next stage of the business, putting that inventory to work. Now that you own those shares, you can start selling covered calls. This is just the reverse of what you did before. You're selling someone the right to buy your shares from you, but at a higher price. And you guessed it, for taking on that obligation, you get paid another premium. And the wheel just keeps on turning. But, and this is really important, I have to be crystal clear about something. None of this works if you're trying to do it with speculative, low-quality companies. The entire foundation of the wheel strategy, the thing that makes it all work, is the quality of the stocks you choose to trade. So here's your blueprint. You're looking for rock-solid companies with strong financials. You want companies that dominate their industry, the ones with what Warren Buffett calls a wide moat that protects them from competition. You don't want to overpay for them, and maybe most importantly, their options have to be liquid, so you can get in and out of your trades nice and easy. Look, if you take only one single thing away from this whole explainer, please let it be this. This is the golden rule. Before you ever click the button to sell a put, you have to ask yourself one simple question. Would I be genuinely happy to own 100 shares of this company at this price for the long haul? If the answer is anything but an immediate and confident yes, you walk away. Period. right, let's get to the fun part. Let's talk numbers. But it is so important to have realistic expectations here. Remember, we are building a business that's designed to generate consistent income. We're not trying to hit the jackpot. Now, the premium you can collect is directly tied to a stock's volatility. So, a stable, low volatility blue chip stock might get you about 1% a month. A more volatile, let's say tech stock, could get you 3, 4, even 5%. But you have to remember that higher premium is just you being compensated for taking on more risk and a higher chance of actually buying the stock. So what does this all add up to over a full year? For someone who's disciplined, who's patient, and who sticks to quality companies, a target of 15 to 30% in annualized returns is a very realistic and achievable goal. And this is the real key. The wheel isn't about trying to beat the S&P 500 in some crazy bull market. It's about generating solid, risk-adjusted returns year in and year out. This strategy really shines in those flat, choppy, or even slightly down markets, because that premium income you're collecting acts like a cushion that simple buy-and-hold investors just don't have. At the end of the day, the wheel strategy is really just a fundamental shift in how you see the market. You stop being a player at the table, just hoping luck is on your side. Instead, you become the house itself, systematically collecting your edge, day after day, week after week. And we all know, the house usually wins. So the only question left is, are you ready to be the house?